So today we're going to talk about judgment and data. And so, I work as a VC, and, as a VC, you're seeing hundreds of companies basically every year. And so a couple of years back, we saw this company, and as you can see, the metrics were not the best. So, it had 200K of ARR, 7% gross margin, and a pretty large burn of 150K. So these are not the best metrics. And, we were thinking, should we invest? And we came to the conclusion that we should not invest because we thought that the metrics were so bad. In fact, we were so sure that we shouldn't invest that we turned this into a case study. And we basically asked all of our upcoming analysts so that they look at this, P&L. And then we wanted them to give an investment recommendation. And the recommendation, obviously, the right answer was that we shouldn't invest, right? And so a couple of years later, the company became Payhawk. And Payhawk is now a billion-dollar company. So, that shows that I'm actually perfectly qualified to give you guys an intro on how to use data and how do you use it to drive your investment decisions. And, I'll talk about a couple of things today. So the first thing is, how do you actually turn data into a formula, or actually, how do you turn your thesis into a formula? I'll also look at cases where the formula was very much wrong, just like the one that I showed you earlier. And then I'll also talk about what we do about it. So what's the secret formula? What you have at every fund is basically a thesis that you believe and that you formulated, that been crafted with all the other GPs. You probably put it on the fundraising deck of the fund as well, but that is actually kind of meaningless to any sort of computer or any sort of machine. So what you need to do is you can actually translate it to, or you need to translate it to something that you can measure. And so something that you can measure is probably data points, right? Something that a machine can ingest. Nowadays AI can ingest more type of data points, but you still need some kind of a data. And so, we at Flashpoint, we have a couple of these like data points, and I'm going to give you some examples on what we do and how do we use it. So for example, one of them is that we back efficient category leaders. Now, internally we use something we call the GREAT score, which is, something that encompasses growth, retention, efficiency, ARR, and time left. Time left is just the runway. And what we do is we, come up with all of these numbers. It uses an LLM to extract these numbers from the notes that we have with the founders. And then that actually helps us to quickly compare all the opportunities that we have in our pipeline. So this is a pretty nice way to see where the winners, the potential hopeful winners are. Another thing that you could do is to look at the visitor share, or like the total visitors, website visitors, and the US geographical share of that. If you think about a category leadership, eventually that company will need to get into the US. And so we think that, the larger that US visitor share is, the more likelihood you have to actually win the US market, which you eventually will have to win in order to have a good outcome and a good exit. So that's something that you could look at, and you could look at, potential providers for that. Another thing that we really like is capital efficiency. So, how much money did the company raise versus the revenues that they have. And then, if you think about how that capital efficiency is eventually achieved, it's coming through like cost control, essentially, right? So you're controlling your costs so that you can achieve the same levels of ARR, but with less money spent. And so what we noticed, and I'm talking sort of close to my home turf here because I'm from Hungary. And so what we noticed is that people from Eastern Europe or Central Eastern Europe, they usually have access to cheaper talent. And so that cheaper talent actually translates to cheaper R&D costs. And so one of the things that we at Flashpoint look at is basically the founder's origin, right? And you could look at like where people went to school, what languages do they speak, and also, how do their names look, right? So when you murdered my name previously, that was actually, my name sounds very Eastern European, and so you could run an algorithm to look at like founders' first names and last names, and that will help you to determine whether they're coming from some sort of an Eastern European country, which gives you a higher chance to have this potential R&D effect. So another thing that you could look at is hiring, right? Like a company is just a collection of people. So if you manage to hire the right people, you will probably have a better chance at winning and making a good investment. So attracting top talent, I mean, this is, you can use a LinkedIn scraper. There are many tools out there, although less and less by the day because they get sued by LinkedIn. But so you use a tool, you scan basically the first couple of hires or the C-suite, and then you can do some sort of a scoring on that to understand whether you're dealing with top-tier talent. You could also look at hiring velocity, like full-time employee growth is some of the or one of the numbers that we use before we talk to the company to assess whether this is interesting or not. And then you can also look at the departmental growth, right? So if you have customer success, and if customer success grows within the company, that's probably a sign that there is good momentum and there are customers being onboarded, right? Same with sales, or if it's a product-led organization, if engineering team is growing, that is probably a sign that they're developing more and more features. Although, I mean, it's changing by the day as well, right, with Claude and all of that. So it's not like a one-to-one relationship, but still, to this day, if you build a large enough company, you will need people for that. So hiring actually is a pretty key indicator here. And then, about the product as well. So if the product is sticky, that probably means that you will have a higher chance of winning long term. So you could look at the typical reviews of G2, Capterra, Reddit. Reddit is a little bit better because there is more balance in that. So I like that personally, but all of the rest works as well. You could also look at the ratio of branded search within the visitors. So we noticed that like branded search is actually a good proxy to PLG. If people already know your brand, they'll start searching for it. And this is something that you will see before actually talking to the company, right? So you will have a better idea which companies are leading with product-led growth versus just like sales. I personally like when a company starts with product-led and then slaps sales on top because it's a more scalable approach versus the other way around. Usually it's very hard to do. And then, your typical metrics of like net dollar retention, MAU, VAU, and DAU, these are, used to be pretty important metrics. They were not that, much in focus for a while, but I think now they're coming back again because a lot of the AI tools have very high usage for a very short period of time, but then people switch onto the next shiny thing and then, they drop it. So NDR and all these usage metrics are super important nowadays. And then, what you could do is you could combine all of that. We at Flashpoint, we look at roughly 5,000 companies a year, and, we have workflows like this. We use a tool called NA10 for this, but you could use anything now. There's even, scheduled workflows in Claude. So whatever like works best, you can use it. Now, there is only one problem with this, right? Is that for the deals that actually made the most value for the fund, none of this actually made any difference, right? So we know all of this, we hired 2 engineers, we have product managers, whatever, but none of it actually made any difference because it actually didn't measure what was the most important, right? So I'm going to talk about like where the formula breaks, and we're going to look at a couple of examples that we had. So I call this the confusion matrix of venture, and so we have 2 axes here. On the one axis is what the data said, and on the other axis is whether we did the investment or not. And so the first category is when the data said no, and we passed as well. So we basically listened to the data, didn't do the investment. Second category is when we flinched and basically the data said yes, but we still said no, and we should, well, it's a question we should have or shouldn't have, but we didn't invest. The third category is when the data said no, but we still did the investment, and we will see that this one is probably the most interesting one. And then the fourth category is the boring one where, data said yes and we did the investment, and then, we just, there was nothing exciting from this perspective. Now, let's look at the first category, which is basically when we missed, and let's look at a couple of examples. So as I mentioned earlier, the company Payhawk, so, you looked at the numbers. I mean, it's not a particularly attractive, or it wasn't particularly attractive opportunity at that time. What we failed to understand is that the 2 founders actually were leading an engineering department in Telerik, which was like the largest startup success in Bulgaria before Payhawk and before any of the modern companies. And also they were pretty obsessed with the whole space. What we thought is that Revolut is going to eat them for lunch, right? Because they also had this corporate card department. We thought that Revolut is going to take over and they have no chance. They ended up raising more than $150 million and became a very large company. So that's a huge miss for us. Second one is a company called GoStudent. It's an Austrian company. Probably people in the DACH region, they probably know this because it used to be like a pretty, important and large company during the pandemic. We looked at them in 2019. They only had 11 months of cohorts. The cohorts looked all right, but they actually had annual contracts, right? So we had no idea whether they're going to renew them or not. And so, we just didn't take the risk. Actually, COVID happened like a couple months later. They blew up. They became a $1 billion company. We could have made a very nice return here. But we missed out on this one because the data said that we shouldn't invest. And then the most famous example is probably Bolt, where we looked at this company. It was called Taxify at the time. Nice little company, but we thought that Uber and Lyft is gonna just destroy them. Also, they had some real estate investors. It was like a pretty weird situation in Estonia, but we failed to kind of understand how much the founders realized that Central Eastern Europe and Africa, some of the overlooked markets, are actually very large. And you can build a very large company off the top of that. So these examples show that the data was actually right about what it measured. It just couldn't really measure the thing that really mattered, right? So we listened, but it didn't make any sense. And so let's look at the next category, which is where we flinched, and the data said that we should invest, but we didn't do the investment. So there was a company in Romania a couple years back. Really nice growth, really nice metrics. Everything looked very nice on paper, but something was a little bit weird. Like, founder had some like weird moments. We had some doubts about some of the customers and whatever. And then, so we actually didn't do the investment. And we ended up being right because a couple of months, let's say half a year later, the company went bankrupt and, it saved us from a lot of embarrassment. So, there are cases where you have to sort of listen to your intuition. And even though the data says yes, you don't need to do the deal. Now, the category C, or the brave call, is basically the most important one, as I said. This is where the data said no, but we still said, okay, let's do the deal. And then if you're right, if you're contrarian and right, then you have potential of winning large. And so we had this company a couple of years back where the founders were with no special pedigree, just like two random guys renting out Airbnbs in Tel Aviv. So, that was not a straight match to the typical sort of venture criteria. There was also not a lot of moat there. So, they were reverse engineering Airbnb's API to kind of understand where do you book and where the bookings come from. So that was not a match as well. But, we still ended up investing. And this company became a Guesty, which is, was a 1.5 million ARR at the time. And now it's at $150 million ARR. So, it actually ended up blowing up and becoming a spectacular category leader. So that shows you that, basically when you're contrarian and right is probably when you have the largest winnings and you can make the best deals. Now, what do we do about all of this? I want to show you like the math of the funnel. So, let's say you start with, as I mentioned, 5,000 companies, and then you have around 1,000 meetings per year. And then we at Flashpoint do around 5 investments a year. So you can see that the drop-off is quite large. And, there is the learning of all of this and like how do we actually use the data is that we don't actually want to like automate everything. We just want to make sure that the automation, it just reduces the judgment need. So it basically helps us to focus only on a couple of cases so that there is not a lot of decision fatigue. And so you only have to use your brain power for like a couple of times a year, and then that will help you to create the optimal outcome. We think that you need to optimize human time and basically spend most of the time on like machine time, where like all of the grunt work can be automated. So back to my examples of Payhawk. I'm actually still not sure if like we would have invested, or if I would invest today. And I can even tell you why. I mean, the company raised, as I mentioned, more than $120 million. And so they raised it at the time when the valuations for companies like PayHawk were really high. And so what that means is that the company today actually cannot raise a round at the valuation that it raised in the last round, right? So they raised too much. They wanted to go a little bit faster than they could or could have, and then now it's actually trying to raise a fund or raise a round for the past 2 years, and it's not working for them. And then now with the multiples collapsing, no one actually knows if you will end up having a successful outcome of with companies like PayHawk. So even though the data kind of forbade us from investing, it still probably could be the right call after all. And that's the beauty of venture, that it probably takes like 10 years for you to figure out whether you were right or wrong, right? So what's the big lesson here, right? I think that the big lesson is that everyone has the data, and you won't really out-analyze others, right? Now with Claude Code and all of that. And so basically the edge is having to have the balls to write the check and make the investment. And that's what never is going to be automated. So yeah, so that's it. Thank you, everyone.